War almost never destroys long-term investors. Panic does. When headlines scream that conflict has spread across 7 nations, your instincts tell you to protect yourself. Sell first, ask questions later, move to cash. Wait until things calm down. It feels responsible. It feels prudent. It feels like what a careful adult should do. And yet, history tells a very different story. The global stock market has lived through world wars, oil embargoes, terrorist attacks, currency crises, and financial collapses. Empires have fallen. Governments have changed. Borders have shifted. Through it all, diversified owners of productive businesses have not only survived, they have grown wealth over time. So the real question is not whether war is serious. It is. The real question is this: when war hits the headlines and markets tremble, what actually happens to your money if you are a long-term investor following a simple, low-cost index strategy? And more importantly, what is the one mistake that quietly destroys more wealth than any foreign conflict ever could? Here is the uncomfortable truth. Markets do not collapse because the world becomes dangerous. They fall because expectations change faster than prices can adjust, and once those new expectations are absorbed, markets begin the slow, steady process of recalibrating to reality. When conflict spreads, investors suddenly imagine lower profits, disrupted trade, rising energy costs, and uncertainty about the future. Prices drop to reflect that uncertainty. But the stock market is not a mirror of today's fear. It is a forward-looking mechanism. It continuously asks one question: what will these businesses earn over the coming decades? If you own a broad market index fund, you do not own a single company dependent on a single region. You own thousands of businesses spread across industries and geographies. Some will suffer in a conflict, others may benefit, many will adapt. Over time, the global economy reorganizes itself around new conditions. Supply chains shift, capital flows adjust, innovation responds. The investor who confuses volatility with permanent loss makes a costly mistake. A temporary decline in price is not the same as a permanent destruction of value. Those are two entirely different events. One is emotional, the other is structural. John Bogle often reminded investors that the stock market is a giant distraction from the business of investing. When war dominates the news cycle, that distraction becomes overwhelming. Red numbers feel like evidence that something irreversible is happening, but the disciplined investor asks a calmer question: have the long-term productive capacities of thousands of companies truly disappeared overnight? The answer, in almost every historical case, has been no. This does not mean markets will not fall. They can fall sharply. They can fall for months. They can even fall for years. But falling prices are not a verdict on the future of capitalism. They are a negotiation between fear and long-term earnings power. There is a deeper layer here that most people never examine. The stock market is not a prediction of peace. It is a claim on human ingenuity. When you buy a total market index fund, you are buying ownership in farms that will still grow food, factories that will still manufacture goods, engineers who will still design solutions, and doctors who will still treat patients. Conflict can slow progress. It rarely eliminates it. The financial media thrives on urgency. Urgency keeps you watching. Urgency makes you feel that action is required immediately, but wealth building is not an urgent activity. It is a patient one. It unfolds over decades, not news cycles. If you are between 25 and 50 years old, building retirement savings through steady contributions, the most important variable in your financial life is not what happens this quarter. It is how you behave across the next 30 years. A single emotional decision made during a geopolitical crisis can undo years of disciplined investing. Consider this carefully. If you invest $10,000 and earn an average return of 8% per year over 30 years, that single contribution grows to more than $100,000. That growth does not happen in a straight line. It happens through recessions, through wars, through political shifts, and through countless frightening headlines. The power comes from time and compounding, not from calm conditions. Now imagine pulling that money out during a sharp downturn because conflict spreads and uncertainty rises. You move to cash. You promise yourself you will get back in when things feel safer. But safety in markets is usually most visible after prices have already recovered. You miss the rebound. The compounding clock is interrupted. The damage is subtle, but it is real. The tragedy is not that war creates volatility. The tragedy is that volatility tempts intelligent people to abandon a rational plan. There's a phrase that experienced investors learn to internalize: volatility is the price of admission. If you want the long-term returns that equities have historically provided, you must accept short-term fluctuations as part of the contract. There is no version of stock market ownership that delivers growth without discomfort. When 7 nations enter conflict, it feels unprecedented. It feels like the rules have changed. But from the perspective of a century of market history, conflict is not an anomaly. It is part of the background noise of civilization. The question facing you is not whether the world will experience turmoil. It will. The question is whether you will structure your financial life in a way that assumes turmoil and still thrives. Most investors spend their energy trying to predict events. The wiser path is to prepare for unpredictability. Broad diversification, low costs, regular contributions, and emotional discipline are not exciting strategies. They are resilient strategies. And resilience, not prediction, is what carries wealth through war. What history reveals about how markets have actually behaved during major conflicts may surprise you even more than this. If you study the record rather than the headlines, a striking pattern emerges. Markets fall when war begins. Then, more often than most people expect, they recover long before the conflict ends. During the Second World War, the United States entered after the attack on Pearl Harbor. Fear was absolute. The future of global stability seemed uncertain. Industrial production had to be redirected toward military needs. Rationing was introduced. Families sent their sons overseas. If ever there were a moment when investors could reasonably conclude that financial markets were doomed, that was it. And yet, within months of that entry into the war, the American stock market formed a bottom. It did not wait for victory. It did not wait for peace treaties. It began to climb while the outcome of the war was still unknown. Investors who sold in the panic locked in losses. Investors who held diversified portfolios participated in a recovery that unfolded even while headlines remained grim. The same pattern appeared during the oil crisis of the 1970s. Energy prices surged. Inflation accelerated. Economic growth slowed. The mood was bleak. Markets declined sharply. It felt as though the economic engine itself had stalled. But companies adapted. Energy efficiency improved. New policies were introduced. Over time, markets adjusted to the new reality and resumed their long upward march. Fast forward to the global financial crisis of 2008. Banks failed. Credit markets froze. Housing prices collapsed. Pundits spoke openly about systemic breakdown. Many intelligent, well-educated investors moved their retirement savings to cash because the fear felt rational. They were not foolish. They were frightened. Then the market turned. It did not wait for unemployment to fall. It did not wait for housing to stabilize completely. It began to rise while the economic data still looked terrible. Those who remained invested experienced one of the strongest bull markets in modern history. Those who fled to safety often struggled to re-enter at the right moment. Notice the common thread. In each case, the scariest headlines appeared near the bottom, not the top. Markets anticipate recovery before the average observer can see it. That is because prices reflect expectations about the future, not a summary of present suffering. When war spreads across several nations, investors imagine worst-case scenarios. Trade disruptions, commodity shocks, regional instability. Those fears are incorporated into prices almost immediately. But the global economy is not static. Businesses search for alternatives. Capital seeks opportunity. Innovation accelerates under pressure. The adjustment process begins long before peace is restored. Now bring this down from history books to your own account balance. Imagine you are 35 years old. You contribute a fixed portion of your paycheck each month to a low-cost total market index fund. You have decades before retirement. War erupts. Markets decline 20% over several months. Your account balance shrinks. It feels like years of savings have evaporated. But what has actually happened? You still own the same proportion of thousands of companies. Their factories still stand. Their employees still work. Their products still serve customers. What changed was the price someone was willing to pay for those earnings under heightened uncertainty. If you continue contributing during that downturn, you are purchasing shares at lower prices. Each monthly investment buys a slightly larger ownership stake. This is not a slogan, it is arithmetic. Lower prices increase expected future returns for new contributions because you are paying less for the same stream of potential earnings. The irony is painful. The moment that feels most dangerous is often the moment when long-term expected returns quietly improve, but human psychology is not designed to appreciate that irony. Loss aversion exerts a powerful force. Behavioral economists have shown that the pain of losing a dollar is felt more intensely than the pleasure of gaining a dollar. When your account declines by $20,000, the emotional response is immediate and visceral. It feels like something has been taken from you, even though you have not sold. The drop feels personal. Recency bias compounds the problem. We overweight what is happening now and assume it will continue indefinitely. If markets have been falling for 3 months, we unconsciously project that trend forward. We struggle to imagine a reversal. The mind prefers a simple narrative of ongoing decline to the uncertainty of a turning point. There is also social proof. When friends, co-workers, and commentators begin discussing moving to cash, the pressure intensifies. No one wants to be the person who stood still while others appeared to act decisively. Selling feels like action, holding feels passive. Yet in investing, disciplined inaction is often the most courageous move. John Bogle emphasized that successful investing is not about brilliance. It is about temperament. The market does not require you to predict wars, elections, or policy shifts. It requires you to endure them without abandoning your plan. Here is the deeper insight. The greatest threat to your money during a war is not the war itself. It is the possibility that you will interrupt compounding by reacting emotionally. Consider 2 investors who both begin with $100,000 in a diversified index fund. Over 30 years, the market delivers an average return of 8% annually. The first investor remains invested through every downturn. The second investor moves to cash during 3 major crises, missing just the best 12 months of recovery across those decades. The difference in final wealth can reach hundreds of thousands of dollars. Not because the second investor was unintelligent, not because the wars were uniquely destructive, but because timing the market requires being right twice, once when you exit and once when you exert. That is a standard few can meet consistently. History does not promise that markets rise smoothly during conflict. It demonstrates that markets have repeatedly recovered from conflict. The pattern is not theoretical. It is documented across generations. The remaining question is the one that feels most uncomfortable. What if this time is different? What if a multi-nation conflict permanently alters the global economic structure in ways we have not seen before? That concern deserves an honest answer. What if this time is different? It is the most powerful objection in investing, and it carries emotional weight for a reason. Every crisis feels unique while you are living through it. Technology changes, alliances shift, weapons evolve. The global economy is more interconnected than it was decades ago. A conflict spanning several nations could disrupt supply chains, energy flows, currencies, and trade relationships in ways that ripple outward. To dismiss that concern casually would be naive. Serious geopolitical conflict can cause real economic damage. It can reduce growth. It can create inflationary pressure. It can lead to recessions. Markets can decline sharply and remain volatile for extended periods. Anyone who suggests otherwise is selling comfort, not truth. But acknowledging risk is not the same as surrendering to it. The question is not whether the world can change. It always does. The question is whether broad ownership of productive enterprise across many industries and regions remains a rational response to an uncertain future. When you own a total market index fund, you do not own a single country's destiny. You own pieces of companies that operate globally. Revenue streams are diversified. Supply chains adapt. If one region suffers, another often expands. Capital migrates toward opportunity. The global economy is not a fragile glass sculpture. It is a dynamic system that reorganizes under pressure. Imagine 2 investors at the onset of a multi-nation conflict. Both are 40 years old. Both have accumulated $500,000 in retirement savings through steady contributions and disciplined investing. The market falls 25% in response to escalating tensions. Their portfolios drop to $375,000. The first investor cannot tolerate the uncertainty. He sells everything and moves to cash. He tells himself he will return when the geopolitical situation stabilizes. The second investor feels the same fear. Her stomach tightens when she checks her account. But she remembers that she owns businesses, not headlines. She continues her monthly contributions. She rebalances her portfolio back to its original allocation. which requires buying more equities at lower prices. Now let time do its quiet work. Over the next 10 years, the conflict gradually resolves. Trade patterns adjust. New industries emerge. Productivity continues. The market delivers an average annual return of 7% over that decade, reflecting a slower but still positive expansion. The second investor's portfolio, starting from $375,000 and compounded at 7% for 10 years, grows to more than $730,000, not including her ongoing contributions. The first investor, sitting in cash, earning minimal interest while waiting for perfect clarity, misses much of that recovery. Even if he re-enters after markets have risen significantly, the compounding base is smaller. The difference is not luck, it is behavior. The objection that this time could be different often hides a deeper fear. What if capitalism itself fails? What if global enterprise collapses in a way that historical precedent cannot guide us through? If that scenario truly unfolds, your brokerage account will not be your primary concern. In an environment where global productive systems cease to function entirely, paper assets lose meaning. But history suggests that societies, even after catastrophic conflict, rebuild. After the devastation of the Second World War, entire cities were reduced to rubble. Within a few decades, many of those economies were thriving again. Markets reflected that rebuilding process. Diversification is not a bet on a single outcome. It is a recognition that you do not know which regions or industries will lead the next phase of growth. By owning the entire market at low cost, you position yourself to participate in whatever recovery shape emerges. There is also a subtle mathematical point that rarely receives attention. Lower prices today imply higher expected future returns, assuming the underlying earnings power of businesses is not permanently destroyed. When fear pushes valuations down, the long-term investor who continues to buy is effectively demanding a higher future return for each dollar invested. This is not optimism. It is basic valuation logic. The emotional core of this decision often appears in quiet moments. Picture a couple sitting at their kitchen table after reading about expanding conflict. They review their retirement accounts. They calculate how many years of work those savings represent. The temptation to protect what they have built feels overwhelming. If they sell, they gain immediate emotional relief. The red numbers stop falling because they are no longer exposed. They sleep slightly better for a few weeks. But months later, when markets begin to recover, a new anxiety appears. When should they get back in? Has the situation improved enough? What if another escalation occurs right after they reinvest? Contrast that with the couple who stay the course. They endure discomfort. They remind themselves that volatility is the price paid for long-term growth. They continue contributing. Years later, when they look back, the period of conflict is visible on a long-term chart, but it is a dip within a broader upward trend. Their wealth was not protected by prediction. It was protected by discipline. The investor who insists that every crisis might be the final one will always find evidence to justify caution. There will always be another potential catastrophe on the horizon. But wealth building requires a different mindset. It requires accepting that uncertainty is permanent and building a system that functions in spite of it. The strongest argument against staying invested during war is emotional, not mathematical. It is the fear of regret, the fear of being the person who held on while everything fell apart. Yet history suggests that the more common regret is selling low and watching recovery from the sidelines. The world will change. It always has. The resilient investor changes strategy only when their personal goals or time horizon shift, not when headlines intensify. If that sounds simple, it is. Simple does not mean easy. Simple does not mean easy. In fact, in investing, simple is often the hardest path to follow because it denies you the drama of constant action. It asks you to trust arithmetic over adrenaline. When war expands and markets fall, your plan does not need to become more complicated. It needs to become more consistent. The foundation remains what it always was. Own the entire market. Keep your costs extremely low. Contribute regularly. Rebalance when allocations drift. Then allow time to do what it has always done for patient owners of productive enterprise. Low costs matter more during turbulent periods than most people realize. If your portfolio earns an average of 7% annually over several decades, but you pay 2% in fees to active managers, advisors, and trading costs, you surrender nearly 1/3 of your gross return. That difference compounds. When $100,000 growing at 7% for 30 years becomes more than $760,000. At 5%, after subtracting 2% in annual costs, it becomes just over $430,000. The gap is not a rounding error. It is the difference between financial flexibility and prolonged dependence on a paycheck. Conflict does not increase the value of high fees, it increases the value of discipline. There is a quiet strength in automation. When your contributions are scheduled to flow into a broad index fund every month, you remove the temptation to time your entry. During downturns, those automatic investments purchase more shares. During rallies, they purchase fewer. Over long periods, this steady rhythm smooths the emotional peaks and valleys that derail so many investors. Rebalancing carries a similar logic. If equities fall sharply and your target allocation was 60% stocks and 40% bonds, your portfolio might shift to 55% stocks and 45% bonds. Rebalancing requires selling a small portion of bonds and buying equities to restore the original ratio. Emotionally, this feels backward. You are buying what just declined. Yet this simple mechanical process forces you to buy low and sell high without predicting anything about the future. Here is the surprising reframe that many investors never fully absorb. Volatility is not a design flaw in the market. It is the mechanism that makes long-term returns possible. If stocks did not fluctuate, if their prices moved in a perfectly smooth line, there would be no reward for enduring uncertainty. Higher expected returns exist precisely because prices can and do fall in response to risk. When 7 nations enter conflict and markets decline, you are witnessing risk being repriced in real time. The discomfort you feel is the price paid for the possibility of long-term growth. Remove that discomfort entirely, and you remove much of the return. This is why the most important asset you possess is not your portfolio. It is your temperament. A well-constructed, low-cost index strategy is powerful, but it only works if you allow it to work. If you find value in calm, evidence-based discussions like this, surrounding yourself with that perspective matters. Financial media will continue to amplify urgency. Social platforms will circulate extreme predictions. Anchoring yourself to a philosophy rooted in decades of data can provide stability when noise grows loud. Choosing that environment intentionally can be as important as choosing the right fund. Another practical layer involves your personal time horizon. If you are decades from retirement, market declines during conflict are not merely threats. They are periods when your future contributions carry greater long-term potential. If you are closer to retirement, maintaining an allocation that includes high-quality bonds provides stability and spending flexibility. The goal is not to eliminate volatility. It is to align it with your stage of life. There is also wisdom in defining success properly. Success during a geopolitical crisis is not outperforming a benchmark. It is adhering to your plan. It is avoiding unnecessary trading. It is keeping costs low. It is sleeping at night because your strategy does not depend on predicting the next headline. The investor who builds wealth quietly over decades often looks boring in the short term. There are no dramatic moves to recount, no bold predictions to boast about. There is simply a pattern of steady ownership and steady contribution. Yet over 20 or 30 years, that pattern can transform modest monthly investments into meaningful financial independence. $10,000 invested annually at an average return of 8% for 30 years grows to more than $1.1 million. That result does not require forecasting wars or recessions. It requires time, discipline, and low friction. War can disrupt economies. It cannot repeal compounding. Compounding operates as long as businesses earn profits and reinvest capital productively. The investor who stays invested during turmoil participates in that process. The investor who exits repeatedly interrupts it. In moments of global tension, it is tempting to search for a special strategy tailored to extraordinary times. The paradox is that extraordinary times often reward ordinary discipline. The principles do not change when headlines intensify. Own the market. Keep costs minimal. Contribute consistently. Rebalance thoughtfully. Measure progress in decades, not days. This is not passivity. It is deliberate restraint. And when you zoom out far enough, you begin to see something that fear obscures. Every past crisis that once felt overwhelming is now a small indentation on a long-term chart. The investors who endured them did not possess superior information. They possessed patience. That patience, more than any prediction about geopolitics, is what shapes your financial future. When you first heard that war had spread across 7 nations, the instinct was immediate. Protect what you have built. Do something. Take control before events spiral further. That instinct is human. It has kept people safe in physical danger for thousands of years. But financial markets are not predators in the dark. They are mechanisms for pricing risk, and risk is never absent from human history. Across the decades, the pattern has repeated with quiet consistency. A crisis erupts, markets fall, commentators declare a new era. Fear feels justified. Then businesses adapt, capital reallocates, innovation responds, markets recover, often long before the crisis is fully resolved. The headlines change, but the underlying engine of productivity keeps turning. If you own a broad, low-cost index fund, you are not betting on peace in any single region. You are participating in the aggregate effort of millions of workers, managers, engineers, and entrepreneurs across the globe. Some of those enterprises will struggle during conflict. Others will find opportunity. Collectively, they will adjust. The central danger was never the existence of war. It was the possibility that fear would push you to interrupt a process that depends on time. Compounding is patient. It does not demand perfect conditions. It asks only that you remain invested long enough for earnings to accumulate and reinvest. Think about the arithmetic we explored. A single $10,000 investment growing at 8% for 30 years becomes more than $100,000. That multiplication of capital does not require calm decades. It requires invested decades. Remove just a few of the strongest recovery periods, and the outcome changes dramatically. Not because the world ended, but because discipline did. The investor who internalizes this truth begins to see volatility differently. A sharp decline during geopolitical conflict is no longer interpreted solely as loss. It is also a repricing of risk that may increase future expected returns. New contributions made during those periods carry the potential for greater long-term impact. This does not eliminate discomfort, it contextualizes it. There is humility embedded in this philosophy. It does not assume you can forecast the trajectory of a multi-nation conflict. It does not assume you can identify the exact moment markets will bottom or peak. It accepts that you cannot know those things with reliable precision. Instead, it builds a system that functions without that knowledge. That system is simple because simplicity travels well through uncertainty. Broad diversification reduces dependence on any single outcome. Low costs ensure that a larger share of market returns accrues to you rather than intermediaries. Regular contributions harness volatility instead of fearing it. Rebalancing maintains alignment with your goals. Time does the heavy lifting. For the working adult saving between ages 25 and 50, the most valuable asset is not the current account balance. It is the span of years ahead. A multi-decade horizon transforms crises into chapters rather than conclusions. When you zoom out across 30 or 40 years, even severe conflicts become segments within a larger narrative of growth and adaptation. This does not mean indifference to human suffering. War carries profound costs beyond financial markets. Recognizing market resilience is not the same as minimizing human tragedy. It is simply acknowledging that economic systems have historically proven capable of rebuilding and evolving after devastation. There is a quiet confidence in remaining invested during turmoil. Not a reckless confidence, not a blind optimism, but a measured belief in the persistence of productive enterprise. When you choose to stay the course, you are affirming that human beings will continue to solve problems, create value, and pursue progress despite conflict. Years from now, you may look back at a chart of this period. You will see a decline. You will see volatility. But if you maintain discipline, you will also see recovery and growth layered on top of it. The fear that once felt overwhelming will appear as one more dip within a long upward trend. The choice in moments like these is rarely dramatic. It is often a decision not to act, not to sell, not to chase safety at the expense of future participation. That restraint can feel anticlimactic. It will not earn applause. It will not produce stories of clever timing. It will simply allow compounding to continue uninterrupted. In a world where 7 nations can enter conflict and markets can fall in days, control feels scarce. Yet you retain control over costs, allocation, contribution rate, and behavior. Those levers matter more to your long-term outcome than any single geopolitical event. War may shake markets. It does not nullify ownership. It does not erase the fundamental reality that businesses exist to generate profits over time. As long as that remains true, patient owners have a claim on that growth. The next time headlines intensify and screens flash red, Remember what you actually own. Not panic, not predictions, not temporary prices. You own a share of the enduring effort of human enterprise. And that effort has outlasted every conflict in history.